Cash flows from operating activities. Here we have an income statement dated December 31st, 2011 with sales, cost of goods sold, gross profit. Operating expenses are salaries, depreciation, rent, amortization of patents, utility expense. Get total expenses of $360,570. Subtract that from our gross profit. Get a profit there of, a gain on sale of equipment, $71.40, and come up with a net income of $556,920. Over here we've got changes in current assets and current liability accounts. And you can see the changes. We've got accounts receivable increased, merchandise inventory increased, accounts payable decreased, and salaries payable decreased. And what we're supposed to do is put together a cash flows from operating activities section of the statement. So we'll start with net income that was $556,920, and we'll make adjustments to this to get the true cash flows from operating activities by making our first adjustment, which would be increase in accounts receivable. So it looks like accounts receivable went up during this accounting period. So if they went up from one accounting period to the next, in this case by $32,050, that means that less cash was collected, therefore it reduces the cash from operating activities by, in this case, $32,050. Also, we have an increase in merchandise inventory. So when merchandise inventory goes up from one accounting period to the next, which in this case it went up by $33,700, that means you're tying more money up into inventory. Therefore, cash for operating activities is reduced. In this case, it's reduced by $33,700. Next, we have a decrease in accounts payable. So if accounts payable went down $13,700 from one accounting period to another, that must mean that we were paying off more accounts payable than we were incurring. Therefore, we're using more cash. And therefore, for operating activities, we want to reduce this cash from operating activities by the amount of accounts payable, how much they decreased, or how much we paid off there, which would be $13,700. We also had a decrease in salaries payable, and that means that we paid off more salaries than we incurred. Therefore, operating cash goes down. In this case, it goes down by $2,550. Next, depreciation expense. We have depreciation expense up here in our income statement of $42,840, and notice that's part of the total expenses that were used to be subtracted from gross profit to come up with our net income. And if depreciation expense is a non-cash expense, then we want to add it back to that $556,920 to get the true cash flow from this income statement. Same thing for amortization expense. Amortization expenses are non-cash expenses. Both of these are both that and so is the depreciation. They're non-cash expenses. And these non-cash expenses have to be added back to this net income figure to come up with the true cash flow from income. So therefore add that back. And we have a gain on the sale of equipment. Equipment, when you buy it or when you sell it, that would be an investing activity. When you buy equipment, that's using cash to make investing activities, and when you sell equipment, that is cash being provided from investing activities. Notice that this gain shows up on the income statement. It's part of something that increases the bottom net income. And if this sale of equipment is going to show up in your investing activities, then we want to get rid of this because it's not really an operating activity cash flow. So therefore we will subtract this $71.40 from this $556,920 to get the true amount of cash flows from this income statement or from operating activities. Now when we make all these changes, we will end up with net cash provided by operating activities of $515,975.